July 2024. A single software update crashes 8.5 million computers worldwide. Airports grind to a halt, hospitals lose access to patient records, and millions of people cannot reach their bank accounts. ATMs go dark, mobile banking apps show nothing but error screens, customer service lines are jammed for hours. This was not a cyber attack. It was a routine software update that went wrong. One vendor, one mistake. Millions of customers locked out of their money. So who is responsible when the technology your bank depends on fails? And more importantly, who makes sure it never happens again? The European Union has an answer. It is called DORA, the Digital Operational Resilience Act, and it changes everything about how banks handle technology risk. According to the FBI IC3 report, cybercrime losses exceeded $12.5 billion globally in 2023. The financial sector was the #1 target. DORA is Europe's response to that threat. In this investigation, I am breaking down the complete DORA Act. What it is, why it exists, its 5 core pillars, real banking, examples, and what it means for every financial institution in Europe and beyond. DORA stands for Digital Operational Resilience Act. Its official name is EU Regulation 2022-2554. In plain language, it forces banks and financial institutions to prove they can keep operating through severe technology incidents. Here is a critical distinction. DORA is a regulation, not a directive. That means it applies directly in every EU member state. No national translation needed. One set of rules across the entire European Union. DORA entered into force on January 16, 2023. Financial institutions had exactly 2 years to prepare. The full compliance deadline was January 17, 2025. That deadline has passed. Enforcement is now active. So who does DORA cover? The scope is massive. Banks, investment firms, payment institutions, insurance companies, trading venues, crypto asset providers, pension funds, and central counterparties. Over 20 types of financial entities. But here is the part that makes DORA revolutionary. It also covers the technology companies that serve these institutions. Cloud providers, core banking software vendors, payment processors, cybersecurity platforms. If you are critical to the financial system, you are in scope. Why did the EU create DORA? Because before it existed, every country had different rules for how banks handled technology risk. It was a patchwork. Some countries had strict cyber rules, others had almost nothing. Meanwhile, the entire financial sector was becoming more dependent on a handful of technology providers. 3 cloud companies now power a significant portion of European banking infrastructure. If one fails, hundreds of institutions could go dark simultaneously. COVID accelerated everything. Banks moved to remote operations almost overnight. Digital transactions surged, and the attack surface for cybercriminals expanded dramatically. The old rules simply could not keep up. DORA has 5 core objectives: strengthen digital resilience, harmonize the rules across Europe, address systemic dependency on cloud providers, protect consumers and financial stability, and streamline incident reporting so regulators can see threats across borders in real time. The bottom line, DORA turns its problems into a supervised risk category at the same level as credit and liquidity risk. Your board is now personally accountable for technology resilience. Let us break down the 5 pillars of DORA. Pillar 1, ICT risk management and governance. This is the foundation of everything. Every financial institution must have a sound, comprehensive, and well-documented ICT risk management framework. It must be integrated into the overall risk management system, not a standalone IT document. Part of the core business strategy. DORA explicitly makes the board and senior management personally accountable for ICT risk. They must approve the strategy, allocate budget, define roles, and oversee third-party arrangements. If the bank fails a resilience test, the board answers for it. The technical standards go deep: multi-factor authentication, encryption of sensitive data at rest and in transit, regular vulnerability scanning, annual penetration testing, network segmentation, intrusion detection, DDoS protection. These are not suggestions, they are requirements. Banks must also maintain detailed inventories of every ICT asset, hardware, software, data, networks, and every third-party service provider connected to them. Think of it like a hospital. A hospital does not just have doctors. It tracks every piece of equipment, every supply chain, every power backup. If the oxygen system fails, they know exactly which wards are affected and how long patients can survive. DORA demands that same level of mapping for banks. The goal is to answer one critical question. If this vendor fails, which customers and services are affected and how badly? Pillar 2, ICT incident management, classification, and reporting. When something goes wrong, DORA dictates exactly how you respond. Banks must have formal internal processes to detect, classify, escalate, and respond to ICT incidents. Every major incident must be documented with root cause analysis and lessons learned. No more brushing things under the carpet. Major incidents must be reported to regulators under strict timelines. Initial notification within 4 to 24 hours. Interim report within 72 hours. Final report within 1 month. The templates have been simplified, but the obligation is absolute. DORA also allows aggregate reporting. If a single cloud outage hits 10 banks at once, the provider or the banking group can submit one coordinated report. This gives regulators real-time visibility into systemic threats. Before DORA, if a bank in Germany and a bank in France were hit by the same cloud outage, their regulators might not know for days that the incidents were connected. Reports went to different authorities in different formats. DORA eliminates that blind spot. Pillar 3, digital operational resilience testing. DORA says you cannot just claim you are resilient, you must prove it. All financial entities except the smallest must run regular vulnerability scans, scenario-based tests, business continuity tests, and disaster recovery tests. Critical systems must be tested at least annually. For larger institutions, DORA requires threat-led penetration testing every 3 years. Think of it as a full red team exercise. Professional attackers simulate real-world cyber threats against your live systems. If your defenses fail, you must fix them. The goal is not to check a box. It is to validate that your impact tolerances can actually be met in practice. Let me give you a concrete example of what resilience testing looks like under DORA. A bank simulates that its primary data center in Frankfurt goes completely offline at 2 a.m. on a Tuesday. Can the secondary site in Dublin take over within the impact tolerance? Can customers still access mobile banking within 60 minutes? That is the test. Can your failover between data centers handle real load? Can your manual backup processes sustain operations when core systems are offline? Pillar 4, ICT third-party risk management and oversight of critical providers. This is the pillar that keeps cloud executives up at night. Banks must maintain a complete register of every ICT third-party arrangement, every cloud contract, every SaaS vendor, every managed service provider. They must classify which ones support critical functions and ensure contracts include specific resilience obligations. Those contracts must include clear service descriptions, SLAs, security obligations, incident reporting duties, audit rights for the bank and regulators, data location requirements, and exit strategies. If you cannot leave a vendor without disruption, DORA considers that a concentration risk. And here is the biggest shift. DORA creates an EU-level oversight framework for critical third-party providers. If a cloud platform is designated as critical to the financial system, European regulators can directly set requirements, request information, and impose corrective measures on them. Regulators no longer accept the cloud provider failed as a black box explanation. There is now coordinated supervisory oversight of systemic concentration risk. The designation process for critical providers is already underway in 2025. Consider this. If 3 cloud providers power 80% of European banking infrastructure, and one of them goes down for 24 hours, that is not just an IT problem. That is a systemic financial risk. DORA forces banks and regulators to map and manage that concentration before it becomes a crisis. Pillar 5, information sharing on cyber threats. DORA recognizes that operational resilience is a collective defense problem. Financial institutions are encouraged to share information about cyber threats and vulnerabilities with each other through trusted communities and ISACs. If one bank detects a new attack pattern, others can prepare before they are targeted. This is especially important against state-sponsored and large-scale criminal attacks. No single bank can defend against a coordinated campaign alone. DORA turns isolated defense into collective resilience. You might be wondering how DORA relates to NIS2, the EU's broader cybersecurity directive. NIS2 covers critical infrastructure across many sectors: energy, transport, healthcare. DORA is specifically designed for financial services and goes much deeper on operational resilience, third-party oversight, and incident reporting. Now let us talk about what happens if you do not comply, because DORA has teeth. Financial institutions can be fined up to 2% of their total worldwide annual turnover. For a major bank, that could mean hundreds of millions of euros. Critical third-party providers face fines up to 5 million euros. Individuals can be fined up to 1 million euros personally. But fines are just the beginning. Regulators can issue binding orders to fix deficiencies. They can suspend business activities. As of 2025, European supervisory authorities are already collecting registers of ICT third-party arrangements from every financial entity. By mid-2025, they will designate the first critical third-party providers. The oversight machine is turning on. They can ban board members, and they can publicly name and shame institutions that fail to comply. Reputational damage can be worse than the fine itself. Let me bring this to life with real scenarios. 4 situations where DORA changes everything. Case 1. A major retail bank runs its online banking and mobile app on a single public cloud region. An infrastructure failure causes a 12-hour outage. Customers cannot log in, view balances, or make payments. Call centers are overwhelmed. Under DORA, that bank should already know which cloud region it depends on, have defined impact tolerances for online banking, and have tested failover scenarios. The cloud contract should include SLAs, audit rights, and exit options. The incident must be reported to regulators within hours. Regulators will now distinguish between a bank that had documented failover plans and tested them versus a bank with no redundancy and no contingency planning. Under DORA, only the unprepared bank faces serious supervisory consequences. Case 2. A mid-sized bank gets hit by ransomware. Attackers gained access through a phishing email, moved laterally through the network, and encrypted core banking and payment systems. ATMs fail, card transactions time out. DORA expects that bank to have had up-to-date patching, strong identity management, multi-factor authentication for administrators, network segmentation, and off-site backups that are regularly tested. The ransomware triggers mandatory supervisory reporting under strict deadlines. If the attack vector was a third-party vendor, DORA requires that the contract included incident notification obligations. The bank cannot hide behind vendor failures. Accountability stays with the institution. Case 3. A widely used security software pushes a faulty update that crashes systems across hundreds of banks simultaneously. This is exactly what happened with the CrowdStrike incident in July 2024. This is precisely the systemic risk DORA was designed for. Banks must understand the criticality of shared vendors, evaluate their change management and rollback capabilities, and ensure contracts require safe deployment practices. Through harmonized reporting, regulators can now see in near real time that multiple banks across multiple countries are affected by the same dependency. That visibility enables a coordinated system-level response instead of isolated firefighting. Case 4. Black Friday. A bank's card processing gateway comes under a distributed denial of service event. Point-of-sale terminals across Europe start failing. Contactless payments time out. Merchants cannot process transactions during the busiest shopping day of the year. DORA expects that bank to have defined impact tolerances for card authorization uptime during peak events. Load tests and denial of service simulations should have been run before the peak period. Given the mass customer impact, this triggers mandatory incident reporting. So what actually changes in practice for banks? Let me walk you through the real-world impact. The shift from best effort to demonstrable resilience. Banks can no longer just say they are resilient. They must produce evidence, documented frameworks, test results, vendor assessments, incident reports. Everything must be auditable. Board reporting changes fundamentally. ICT risk now appears alongside credit and liquidity risk in every board pack. Directors must understand technology dependencies. If they cannot explain the bank's cloud strategy and its risks, they are failing their DORA obligations. Budget allocation shifts too. Resilience is no longer optional spending. It is a regulatory requirement with direct board accountability. Banks that historically underfunded IT security now face compliance pressure to invest. If you are watching this and thinking, where do we even start? Here is the implementation roadmap most banks are following. Let me crystallize why DORA matters specifically for banks. 5 reasons. 1. ICT risk is now a fully supervised risk category. Boards can be held accountable for underinvestment in resilience, the same way they can for capital or liquidity shortfalls. 2. DORA clarifies expectations in the era of cloud dependency. The EU now says clearly, if you put core banking on a handful of cloud providers, you must demonstrate that you understand and can mitigate concentration risk. 3. Incident reporting is now standardized across the entire EU. One common language, one process, one timeline. This reduces confusion and underreporting. 4. Consumer trust and stability. Customers may never know DORA's name, but they will feel its impact if it reduces the frequency and duration of outages for online banking, ATMs, and card payments. 5. Alignment with supervisory focus on hybrid threats. The European Central Bank now receives both cyber and non-cyber ICT incident reports under DORA. This supports a holistic view of resilience against all types of digital disruption. And here is the perspective I want to leave you with. DORA is not just a compliance burden. It is an opportunity. The firms that treat DORA as a chance to fix structural weaknesses will be the ones still standing when the next major outage hits, and it will hit. Think of DORA not as a compliance checkbox, but as a survival toolkit in a hyper-digital financial system. The institutions that invest in real resilience today will have a competitive advantage tomorrow. DORA does not just affect European banks. Any technology company anywhere in the world that provides critical services to EU financial institutions falls under DORA oversight. A cloud provider in the United States serving a German bank must comply. A cybersecurity vendor in Israel protecting a French insurer must comply. DORA has global reach. Even the United Kingdom, which is no longer in the EU, is developing its own operational resilience framework with similar principles. The Bank of England and the FCA have their own rules that mirror many of DORA requirements. This is becoming a global standard, not just a European one. And here is something many people miss. DORA covers crypto asset service providers too. If you operate a crypto exchange, a wallet service, or issue tokens within the EU, you must meet the same operational resilience standards as a traditional bank. The playing field has been leveled. But I want to end with something that gets lost in the technical details. DORA exists because real people depend on the financial system working. When your salary does not arrive because of a system failure, when you cannot pay your mortgage because your bank app is down, when a small business cannot accept card payments during their busiest week, those are real consequences. DORA is about protecting those people. The question is no longer whether a major digital disruption will hit the financial system. It is when. DORA is the answer to that when, and the institutions that embrace it now, not as a burden but as a blueprint for survival, will be the ones that earn trust in the years ahead. If this deep dive into DORA was valuable, subscribe for weekly fraud intelligence and regulatory analysis from DaVinciDiligence. We break down the regulations that protect your money. Drop a comment below. Is your organization DORA compliant? What has been the biggest challenge? I read every single response. Next week, I'm investigating how a $272 million fraud drained a Ray-Ban maker's account, while JP Morgan missed every red flag. You do not want to miss that one. Some banks are already ahead. Rabobank, for instance, has publicly stated that they launched a dedicated DORA implementation program to close remaining gaps. They view DORA's requirements for ICT service providers as extending the same standards to those providers as to the bank itself. Phase 4, testing and continuous improvement. Run your resilience tests, conduct threat-led penetration testing. Fix what breaks. Update your incident response plans, and then test again. DORA compliance is not a one-time project. It is a permanent operating model. Phase 3, vendor remediation. Review every ICT contract. Ensure critical vendor agreements include DORA-mandated clauses for SLAs, incident reporting, audit access, and exit strategies. This alone can take months for a large bank. Phase 2, governance and policy updates. Rewrite your ICT risk framework, update board mandates, establish an independent ICT risk control function, and define impact tolerances for every critical business service. Phase 1, Gap analysis. Compare your current ICT risk management framework against DORA requirements. Identify where you fall short. Most banks find gaps in vendor registers, incident reporting timelines, and board-level accountability structures. Industry experts expect that the cloud outages and systemic incidents of 2025 and 2026 will be treated by regulators as test cases for DORA compliance. Banks that prepared will be treated very differently from banks that did not. If your institution falls under both DORA and NIS2, DORA takes priority for digital operational resilience requirements, but you still need to comply with NIS2 for broader cybersecurity governance. Think of DORA as the specialized deeper layer for finance, and DORA requires exit strategies. If your bank depends on one cloud provider for core banking, you need a documented plan for how you would migrate to an alternative if that relationship fails. No more vendor lock-in without a backup plan. DORA is proportional. A massive global bank faces different testing requirements than a small fintech, but the principle is the same for everyone. You must prove your systems can survive real-world stress, not just pass a paper checklist.